G'day guys, and welcome to episode 1 of Brisbane Real Estate Tips. This is our first episode, so really excited to get into things. BrisbaneRealEstateTips.com has been around for a little bit now. We've just been basically producing blogs with valuable content for all people interested in real estate. Now we're starting a new little webcast, and our first guest is Stuart Pullar from Mortgage Choice. Stuart, thanks for joining us.
Thank you.
No worries. Can you tell us a little bit about yourself, Stuart?
Sure. Stuart Puller. I've been a mortgage broker with Mortgage Choice now for 7 years, and the last 5 of them I've actually had my own franchise here at Ashgrove in Brisbane.
Cool, excellent. And whereabouts in Ashgrove are you?
Okay, we're right in the heart of Ashgrove, just opposite the Woolworths on Ashgrove Avenue, which is a good spot to be.
Definitely. All right, well, I will launch into a few questions, and then basically after that we'll roll into a few sort of rapid fire questions that will let us know a little bit about your personality. So we'll float in from there. So this is, I guess, a question that is directed to particularly the younger generation. So I guess, my generation. So your best advice for young people when getting a loan for property? What would be your best advice?
Best advice is just to do your planning. Get prepared ahead of time. There's nothing like coming to see a financial person, a broker, at least 3 months out from when you're planning on buying, because getting that pre-approval in place, or even just getting some of the initial stuff sorted out, is really important. There's a lot of bank jargon and a lot of bank logic that makes no sense whatsoever in the real world. Things like what is genuine savings, what you need to have for a deposit, things that you can do for your job, etc. That if you leave it to the last minute, you may not have time, and you might find a property that you then miss out on because you haven't got those things in place. So coming to see a broker, get your ducks lined up, and then the best practice would be to put in a pre-approval to the bank of your choice. They come back and say yes, and then you can go shopping with confidence. It gives you a really good edge on other potential buyers because you're ready to go and you know exactly what you can negotiate around.
Cool, and that's obviously something you'd see quite often, I'm guessing, with people in the market.
Absolutely, in terms of pre-approvals.
Yeah, with people sort of having a bit of a stab themselves and then sort of rocking up to you. I guess when the I guess going's already gone.
Yeah, absolutely. We can take over a deal sort of part way through, and it can be very difficult because we might have missed the finance. The bank might have turned around and said no because they approached the wrong bank to start with, and then obviously we're all stressed and running around trying to get things approved. And in some cases, if they had come to us 3 months earlier, it would have actually been quite easy to get them to the position where they would have been fine. So absolutely, it can go quite wrong if you don't do things in a logical order.
Yeah, that's right. Because I could imagine a lot of people would be shopping on realestate.com and going to open homes and that without first getting their pre-approval sorted out.
Correct. So people start by finding something they love, and that's often the motivation. But then they do their homework. So it's not uncommon for people to come to us with a contract. But look, I think as brokers, we're now doing 50% plus of all the loans originated in the country. So I think there are a lot of people out there who know the benefit and understand the benefit of doing the homework and coming to a broker before they do anything else. So set them up for success.
Yeah, cool. And so I guess following on from that, when you first meet with a client, what should they expect from you? Like, what should they have? You said before to have their ducks in line. What sort of things do they need to get that pre-approval? I mean, besides basic income statements and all that sort of stuff that I guess you see a lot of people forget when first sort of seeing you.
Yeah, absolutely. Look, we try and keep things as simple as possible for clients. We do all the paperwork, we fill out all the forms. So you can expect for us to get in contact with you really quickly. You can expect us to do basically all the running around trying to find the right loan, all the paperwork. All you need to do is sign. In terms of the sorts of things you need to bring, pretty standard. If you're work for a company, a PAYG, you'll just need a couple of pay slips, and that's enough to get us started to work out whether you can actually get the loan that you're looking for. But after that, the next important thing is to make sure we understand where your finances are in terms of the funds that you need to complete for your deposit, and whether they are genuine savings, which means you've held them for 3 months, or whether they're coming from a gift. Some of the little things that can trick people up, sometimes you need HEX statements and so on. So again, that's why the pre-approval can be good, because you can be running around for those things before the clock is ticking, before you've signed that contract. But generally, make an appointment, I'll sit down with you, run through a series of questions just to make sure I understand exactly what you are wanting to do, what your future plans are, what your goals are, and really understand what's important to you about a loan. And then from there we can advise as to which of the 26 lenders on our panel, and of them, which loans might be the most suitable for your needs.
Yeah, okay. And a quick question, obviously, particularly my generation, and I know it's an issue amongst, even older sort of generations, where people leverage up on their credit cards. I have worked sort of, I guess alongside your industry. I think you're aware of that. How much would for instance, let's say someone has 3 credit cards with $5,000 each on them. How much does that actually affect their lending ability?
Okay, well, that can have an impact, and obviously it depends on the overall strength of the deal. But as a rough guide, most lenders will take 3% of the limit of the credit card. So whether you even have that debt on them or not, 3% of the total limit will be taken as part of your costs. So that actually will reduce your total borrowing capacity. So if you had $15,000 worth of credit cards in one scenario and didn't in another, that could add as much as $20,000 to $30,000 worth of extra borrowing capacity, which may or may not make the difference between achieving your goal. So they certainly do make a impact, and obviously the best thing that you can do is to minimize your non-secured debt, because obviously that's what's known as bad debt. But also, another reason why coming to see a broker beforehand can be important is around that genuine savings issue. Any number of clients come to me and go, "Great news, I've paid off my credit card, I no longer have that, but now my mum and dad are going to give me some money to help fund the loan." Whereas if they'd come to me and they'd had the $15,000 in the bank, and we went to the bank and said, "Right, we're paying off these credit cards," that $15,000 would be considered genuine savings, and they would tick that box. And even though they used those funds to pay off the credit card, they would still be able to get that loan that required genuine savings. So like I said, these things don't make any sense in the real world, but it's bank logic, and that's why seeing a broker and having those things explained can stop you making a mistake that might actually then delay your whole process by 3 months.
Yeah, wow, that's actually really, really interesting to know. I'm sure a lot of people would get value out of that. It's just something really simple, like you said. It's paper logic. It's not logical in the real world, but it's paper logic. And you may or may not be able to dispel this rumor for me. This is something that a mate of mine told me a long time ago, and obviously he's very cautious with his credit rating. Now, if I miss a mobile phone payment, and this is coming out of the blue, by the way, guys, this is not something I've discussed with Stuart before, but if I miss a mobile phone payment, is that really going to affect my chances getting a $500,000 home loan?
Okay, the very short answer to that is probably not, but the whole credit rating regime has changed dramatically over the last 12 months and will continue to change. So it's a sort of watch this space, but we've moved from a negative credit rating environment to a positive credit rating environment. And what that basically means that in the past, you're only going to be listed if you did something quite bad. So missing the odd payment by a month and maybe making it up again probably isn't going to be devastating in terms of your lending. You would need to get a default, like it would go to collections or something like that. So you've got to do something reasonably serious. So minor stuff, missing a payment, but if you don't pay that bill for your phone bill, and then you sort of get into some sort of dispute, and then they list you, then absolutely that has a major impact. So the bottom line is you should try and keep in control of all of your payments. I certainly wouldn't advise not to, but if it's just a really minor thing, then probably not a king hit. But again, going back to what we said before, if you come to a broker 3 months out or more, and I can do a credit check that has no impact on your credit statement. We can just do a quick check to find out what's on your statement, and I can give you peace of mind that whatever that thing that you think is haunting you, I can let you know whether it is an issue or not. If it's not, great, we move on, and if it is, well, then I can advise you as to what you need to do. And at least you haven't then applied for credit when there's absolutely no chance that you're going to be able to get there, and you can put those steps in place. So mostly, I had a loan the other day where they thought they might have been in a bit of trouble, but we did a credit check and it scored absolutely fine, so we were able to proceed. So again, just come, get the information, work out exactly where you stand, and make the best plan to move forward.
Fantastic, fantastic. Oh, I'll happily share this with my friend who told me otherwise. So obviously, Stuart, going to mortgage choice, the benefit of getting yourself is there. The benefits for, I guess, yourself working for mortgage choice and your ability to service your clients better. Are you able to explain that a little bit more thoroughly?
Yeah, sure can. Look, Mortgage Choice is a broker, so similar to other brokers outside of Mortgage Choice, the benefit of going to a broker instead of a branch, say, is that we have a range of lender options that we can provide. So if you go to a bank, they can really only provide you the best loans that they have, which may not be the most suitable for your circumstances. In the current environment, a lot of pricing is based on things like how much you're borrowing, what your loan to value ratio is, and that can have a big impact on the pricing you'll get for one bank to another bank. It might be as high as a percentage point, typically around half a percentage point difference from what you might get just by picking the right bank. So even without getting you a better price at an individual bank, by picking the right one for you, we can, one, get you a better rate, two, make sure you don't have the loan fall over, then have to start again or maybe miss out on the property, and then three, make sure we've covered off all the things that make the loan suitable for you. So it's fixed versus variable, is it got an offset account, or is there a simple redraw? What is important to you, so you only pay for what you need and you don't pay for what you don't need. Now in terms of Mortgage Choice though, one of the things that I really love about working for Mortgage Choice is that we have a unique system. So with most brokers, they get paid, each bank pays a little bit differently in terms of the commission structures. With Mortgage Choice, we have this unique model called aggregation, but it basically means all the money comes in from the banks to the franchisor level, and they average it out so that when they pay the franchisees or the loan writers, we get paid exactly the same for every loan. And that takes out a huge amount of bias. So when I'm talking to my clients, and they're thinking St. George versus Suncorp versus ING, I am absolutely confident that it makes no difference to me in terms of how much I get paid. It makes no difference whether they have a line of credit or it's interest only or whether it's under a package. It's exactly the same compensation. So I can just put all that to one side and absolutely focus on what's best for the client's needs. And I find that to be a wonderful thing about working for Mortgage Choice.
Cool, excellent. And obviously, yeah, that flexibility there will help a lot of people. This is probably a personal question, but will benefit the everyone listening. Is when you bank with someone, say for CBA all the way from their little I forget the little piggy bank that they start in school. Yeah, those ones. So say if you're with CBA, that a lot of people think that that means that they're going to end up with a loan with the Commonwealth Bank at the end of the day, and obviously that's CBA's plan, and it probably was, or definitely was from the get-go on the launch of that particular idea. I think, am I correct in saying that I guess brokers like Mortgage Choice have made that sort of almost redundant, where people, they might have a bank account with their salary going into CBA, but they might have a loan with NAB, and that makes zero difference to their financial position.
Look, absolutely, and the Commonwealth Bank's an interesting one. The Dolomite factor is still really large. You'd be amazed. My kids are Dolomites, and so the program still exists. They're creating a new generation of loyal fans. But
I was never
there are
a Dolomite.
a number of clients who No, I wasn't. I was an NAB equivalent, but look, they do a great job, and then it does engender some loyalty in the consumers. I'm not entirely convinced that that loyalty is rewarded by the lenders, and a lot of people feel aggrieved that they can't get better rates because they've been in a dolomite say or two. And unfortunately, to borrowing and what your loan to value ratio is basically. Now, Commonwealth Bank is a good example. They really do this loan to value ratio and loan size pricing. So generally speaking, if you have a loan above $500,000 and a loan to value ratio of 80% or less, then you're going to get really good pricing. And that's sort of what I was alluding to before, in fact, about picking the right bank. So you might find that because you're a first-time buyer and therefore you might be buying with a limited deposit and maybe a slightly smaller loan to get started, then Commonwealth Bank might not be the right one for you. Maybe one of the smaller banks like CUA or Suncorp or ING might, in fact, in the current market, and this changes again, come and see a broker when you're ready to proceed and we'll tell you the best one. But they don't price on loan to value ratio or loan size, then you're going to get a substantially better deal. And so any number of times you have a customer say, look, I'm a Dolomite, I went to Commonwealth Bank, they told me this rate, I talked to some friends around the water cooler, equivalent thereof, and they said, oh, look, I think you should go and see a broker because that sounds a bit high. And indeed, because they're borrowing $300,000 at 90%, they can get a much better rate somewhere else. So that's not to pick on CommBank. All banks, there are many, many times where people come to me, they want CommBank, and it is the best one. Even if I send them back to the guy CommBank who was helping them, because that's just the best advice for the customer. But again, it doesn't hurt to check. A couple minutes to the main bank might avoid a costly mistake.
Cool, cool, excellent. And I guess getting a little bit more Brisbane focused. Obviously, you service the Ashgrove area quite well, and you've got clients, I'm guessing, all over Brisbane. I'm not sure whether you can actually tell me this or not, but can you see an area in Brisbane that I guess is being particularly heavily invested into, or are you able to give that up, or is that?
Look, I can give some observations. Obviously, we're a reasonably big brokerage, but even so, we do a smallish percentage of the number of loans being written in the city. But I have two franchise areas, so we actually cover by license all of the inner North Brisbane suburbs from Enoggera through to the airport. So a pretty big area, and that's where most of our clients come from. But obviously, for existing clients who have moved away and still want to work with us, or for referral business that people want to send us to see our friends, we'll get in a car and go anywhere. So we're not worried. If there's somebody to help, we will travel and we will help them. But just in terms of the inner North Brisbane suburbs, if there was an area that I'd pick out, it's probably the two areas, probably the sort of the Mitchelton area, and then possibly the Stafford Heights area, although that's probably cooling a little bit over the last 6 months. Certainly between 6 and 18 months ago, that area was very hot and probably quietened down a little bit. But certainly that's an area where a lot of my clients seem to be looking for investment property at the moment.
Yeah, okay, excellent. Oh, it's good to know. And I guess this is going on to a real estate, more of a real estate discussion from a real estate agent. As if the viewers don't already know, I am a real estate agent. Often before selling a property, clients will call us first. They'll call the real estate agent first. I think I spoke to you about this. I think potentially it should be the other way around, because I think your ability to talk about what their expectations about needing to, whether it's draw down the loan, what they're looking at doing in the future, if they have, existing debt they need to pay down, what is a reasonable amount, not based on an appraisal figure, because appraisal figures are plucked out of the air. Let's be completely honest here. I think generally, going to see a financial planner or a mortgage broker is probably a very good idea in the first place. Is that something that you agree with?
I'd completely agree with that. Look, just like people can go and sign a purchase contract and then come along to a broker and find out whether they can or can't get finance, people also put the house on the market before they sort of work out where they're going next. And I don't think you can get finance information early enough in the process. We've got clients who we might not help for sort of 12 to 18 months from when we initially see them, but they're just getting their ducks in line and making sure that they're good to go. So some of the things that come up on the sales side is, well, what's your plan next? Do you have the equity to be able to get into the house you want to go into next? Is there what sort of price do you need to sell your property for to be able to realize your purchase goal? And that might be higher or lower than expectations depending on the new loan and what that loan might cost you and what mortgage insurance might be, etc. And then there's questions about bridging finance. There might be an opportunity if you don't want to sell your property and you want to buy the other one so that you can transition your family without having to move twice, and you want to get the place vacated so that you can get that ready for sale and then get it on the market. Bridging finance might be the way to go. And there's also a simultaneous buy and sell. So if you've bought a property at say with mortgage insurance, so above 80%, and you've paid $10,000 or $15,000 worth of mortgage insurance, by structuring it right and going back to the same lender, you might actually be able to avoid having to pay that mortgage insurance again. So if you just pay out that loan and then look around for another one, that might have cost you $15,000 that you could have avoided just by doing a simultaneous buy and sell. Now that comes with some implications. Obviously, you've got to find a property that you can sell and buy at the same time, and that might put you at a disadvantage to the rest of the market. But if you have 15,000 reasons to do that in terms of saving money, then maybe that's the best way to move forward. So it's always best to know these things in advance, and then you can make informed decisions as to how you want to proceed.
Yeah, that's right. I guess it's like, to put an analogy, I guess in place, it's like going up against a sporting team. You want to know who their key players are to defend and all that sort of stuff, and who you want to attack offensively. It is a game of chess. That's the way I sort of see it in terms of real estate and finance. But yeah, certainly for those people who are listening, if I do get a call in relation to sellers, I will be putting them straight through to Stuart to help them understand a little bit about where they should be sort of looking in terms of their plans for the future, because my appraisal figure means nothing at the end of the day. All it is a figure, and it's up to the actual market to determine what that property is actually worth. And if it's worth less than what the appraisal figure is, but it works financially for the client, I think that's still a good deal. It's an achievable deal. So that's why I like to get I guess my ducks in line in terms of the finance sorted at the same time. Rather than just sort of being a one-trick pony and hoping for the best. So that's something we'll work on, I'm sure.
The main thing to say is that it's not rocket surgery. It's not complicated stuff. But you don't know what you don't know, and most of the things, just as I said many times already, that they're not intuitive. So you're not going to, as a person who's not intimately involved in the finance side of things, necessarily going to think of all the implications. But because I've seen thousands of scenarios, I can fairly quickly lead you through the path to of least resistance and also fewest errors, and that can save you a lot of time, money, and stress.
Yeah, I can imagine so. And look, before we jump into like a few rapid fire questions, like I said at the beginning, there's been a lot of media and a lot of press around the Sydney and Melbourne markets at the moment in terms of whether or not there's going to be a bubble. I just wanted your opinion whether it's going to affect whether you think it will affect Brisbane, or is it already affecting Brisbane? I have my own opinion, and I'm writing a piece on that on the blog. So the readers of my blog can stay tuned for that. But Stuart, do you have an opinion on that at all?
Look, I do. I probably won't speculate too much on whether there's a bubble going on in Sydney. I certainly think the prices are extraordinarily high. So, and it looks like it's not a buyer's market to my eye. I'd be very cautious buying at the sort of prices that they are there at the moment. Now, one of the main reasons why it's going to affect Brisbane and in fact the entire Australian market is that APRA, our major regulator, is talking to all the banks to try and put a dampener on this investor market particularly, and also trying to cool Sydney. So that's actually had a big impact. It's made the market for finance a lot more complicated, because now you've got all different banks responding to APRA differently based on what their current growth rate is for investment. They're all basically been told that they can't grow by more than 10%. So the ones that are growing above that obviously have to clip their wings a lot more than the ones that aren't. So look, I don't think net that it's going to have a big impact on the market, particularly in Brisbane. I think Brisbane isn't in a bubble. I think that if anything, there'll be people from the Sydney market maybe looking to purchase in this market as opposed to Sydney, because they might perceive that that'd be better value. But also, I think it'll just change the lender solution for people. So the lenders that aren't currently having an appetite for investment finance will probably stop writing the loans, but somebody will. My biggest concern, and it was shared last night by our CEO on Business Show, is that the people who are determined to get finance, who are in that marginal area that lenders don't want to lend to them, will go somewhere. And there are lenders out there that are far more risky than the 26 lenders that I represent. So that's my biggest concern. So anybody who isn't able to get a mainstream loan in the current market when rates are so low, they really should take pause before entering into a finance contract with sort of a third tier lender, because I think paying extra rates and so on and so forth is probably a pretty risky thing to do. But if it's just a matter of saying, well, NAB no longer wants my business, or CBA no longer wants my business, but such and such a bank will, then I think it'll just be a matter of shifting deck chairs. And when it comes to the broking space, I actually see it as a positive thing for the brokers out there, because more complexity just means more need to actually consult a broker. I've had any number of clients who, in the last 6 months, who probably would have just gone to their bank before, and now they're saying, well, I've got absolutely no idea. I want to do this investment project, but my bank's not able to sort of give me the information I need. So we're actually finding the inquiry rate is increasing rather than decreasing.
And do you think the sort of the government's talks about sort of dispelling negative gearing will have sort of the same effect as well?
Well, I'd be quite surprised if negative gearing goes. I think that just like APRA's moves now in terms of trying to cool the market has this unintended consequences I was talking about, with meaning that people who have income and equity can still buy investment properties. People who are maybe a little bit more marginal can't, so it just increases that haves versus have-nots. The negative gearing thing is a lot more nuanced than the political representatives are making out at the moment, which isn't too surprising. But the Greens, for example, with their statement that they're going to save $3 billion, is very one-sided when you consider that the whole reason for negative gearing in the first place was to provide an incentive for investors to provide low-cost rental. So because there are now a lot of rental properties out on the market, it means that people who need to rent can do so cost-effectively. I mean, if that goes and the government has to start moving back into social housing, that's going to come at a cost that will dwarf the sort of savings that they're going to save from negative gearing. So it is not a straightforward argument at all. I don't have all the answers. I think the fact that we've moved to 50% of the total purchases in the country now being investments sounds pretty high, when it was 70 to 80% a generation ago that was owner-occupied. So I'm not saying that gung ho, let's keep negative gearing going. But it's certainly a more nuanced and subtle argument as to what would happen or how best to unwind it. So I don't think anyone has the political will for that personally. So I would be quite surprised if it gets wound back, particularly for existing negative
Yeah,
gearing arrangements. So watch this
like you
space.
said.
But I'm not sure at all that it will happen, or that it would be a good idea if it did, depending on how it does. It's a very nuanced thing that would need to be done to unwind the negative gearing properly.
Yeah, and like you said, they're potentially missing out on 50% of the vote, just as a base example there. So, yeah, who knows?
Absolutely. So it's it would be a brave politician to cancel it outright.
Yep, that's right. That's right. All right, well, yeah, enough about politics. I don't really like politics anyway. Um, we'll jump into a few rapid fire questions and then we'll wrap up if
Definitely.
that's all right. All right,
Sounds great.
so if you could recommend any book or resource that I guess has helped you improve your sort of property and financial knowledge over time, is there one particular choice you'd have?
Yeah, I think so. Look, given this is your first web chat, I'm going to go with the classic, I think, and pick Rich Dad Poor Dad, because it's not a property book per se, but it has some fundamental information there that really has had a profound impact on my understanding of building small businesses and investing in assets and property. And I think it's an absolute cracker for anybody who just wants to get a good, simple, and well-written example of the fundamentals of building success through building wealth through and so on. So that's a good one. I'm a bit leery of property books that claim that you can buy 427 properties by Thursday, and so on. So things that are just fundamental, that are buying assets that are sound, sensible, and so on, and using the value of time. I mean, for most people, particularly the Gen Y and younger demographics, there's plenty of time to make sensible steps to build a property portfolio or build up other assets. So you don't have to get rich quick. You just have to get rich sensibly and make slow and steady progress towards your goals. And that's a much better way to get there in the end. So yeah, watch those get rich quick books.
Yeah, I think Robert Kiyosaki did a fantastic job with those. That's for sure. I've read
Absolutely.
all of them. So yeah, fantastic.
Pretty much. Yeah. Pretty much.
So next, it's a double part question, but your favourite suburb in Brisbane, and that's to live in and to invest in.
Oh, all right. Well, I think my favourite suburb to live in has got to be my own, which is the Gap. The Gap's an absolutely fantastic little treasure, which I probably shouldn't spruik too much, because I don't think people realise how wonderful it is to be 10 kilometres from the CBD and still in a leafy, essentially large cul-de-sac of a suburb. It's just a brilliant place to live. In terms of rental, investment, I like the sort of the around the university in Kelvin Grove and so on, like that sort of area around the QUT campus.
Yeah, cool, excellent. And last one before we wrap up. Uh, this may generate you some business. Oh, we hope. So for all those people that are looking to buy you presents, thank you presents, do you prefer beer or wine?
I'd definitely say wine, a red wine
Wine?
drinker.
Yeah. Anything in
Yeah,
particular? Red wine. Okay, there we go.
red wine.
Fantastic.
There you
Well,
go.
Stuart, thanks very much for being the first
Absolute
guest
pleasure. It's a
on
great
the
honour.
webcast. Thank you. And if anyone wants to get in contact with you, what's the best way?
Oh, give me a call on my mobile, 0414 408 535.
Excellent. And I've got Stuart's email as well in the description. So otherwise, you can always email me and I can pass on Stuart's details. So guys, that wraps up the first instalment to Brisbane Real Estate Tips webcast number 1. So again, thanks to Stuart for hanging around, and we'll see you next time.
Thank you.